Good morning, everyone. Hope you're well. Welcome to the Grovest webinar series, part 1, Financial Planning for Young Professionals. We've got a really exciting lineup today. Today's webinar is facilitated by Grovest. What we're trying to do is have the conversations that need to be had. This is just one part of many series that are to come. And what we're going to be doing today is meeting with EasyEquities, with Standwa from EasyEquities, and with Wilco from Harbour Wealth. And we're really going to be talking about financial planning for young professionals. I think it's a really important point to discuss because young professionals, your environment is changing constantly, your financial needs, your situations, your investment ability. And with all these changes, people often don't really know what to do. So what we're going to do is just have a roundtable conversation with Standwa and with Wilco, and they're going to talk about some investment trends. We're going to talk to some financial habits that are important to have. And I think it's going to be really exciting. So just to understand maybe in terms of process, there's a Q&A button at the bottom of your screen. Please feel free to ask us questions throughout the webinar. At the end of each session, we're going to answer one or two questions. If your questions aren't answered throughout, please don't worry. We're going to send out some answers to you afterwards. The webinar is going to be recorded and recordings will be available thereafter. Thank you all for joining us. We're very excited and looking forward to a great session. Maybe Wilco, if you can just turn on your camera, we can kick off. The first speaker is going to be Standwa Nongauza. He's from EasyEquities. He's on his own financial journey with thousands of other young easy investors, building wealth one step at a time. Standwa, thanks for joining us. Just so everyone knows, I've been working with Standwa for, close to 2 years now, and is a rock star, not just a brand rock star.
How's it, everyone? As Avi, great introduction, thanks, man. As Avi stated, I work at EasyEquities and I'm one half of the brand management team. And yeah, pretty much what we do is managing the brand at EasyEquities and sharing experiences and making sure everyone is invested, everyone in the country. Our aim is to get the whole country invested, pretty much. So that's really the spiel about EasyEquities. And we're a company that specializes in investment in the stock markets. And it's a platform that allows you to buy shares at fractions as well as whole shares. And so that's really what I'm about and what we're about at EasyEquities.
Thanks, Stans. I think that's awesome. Something I've personally really enjoyed. I invest through the EasyEquities platform. I think it's amazing. And I think, if I'm not mistaken, you're the only company in the country that offers fractional shares. All right.
That's correct. Yeah, we're the only company in the country that offers it. And so that allows us to actually have very low cost solutions. We don't have minimums, there's no registration fees, and our brokerage fees are minuscule. So yeah, we're disrupting the industry pretty much.
Amazing. That's awesome, Stan. Thanks. Just maybe to briefly introduce our second panelist, or third panelist, depends where you come from, Wilco Jonker. Wilco Jonker is a wealth manager and the regional head at Harbour Wealth. He's married with 3 kids. He lives in Pretoria. He's very passionate about the financial services industry and educating individuals about how to make the right decisions. Thanks so much for joining us here today, Wilco. And maybe you can just give us a little bit of background about what Harbour Wealth is, what you stand for, how you do it.
All right, perfect. Thanks, Avi. And first of all, thanks for having us. I think this is an amazing platform. And what you just said there is my passion is to educate. I think the same with what Standwa just said is we want everyone in South Africa to be able to invest, but we also want people in South Africa to make the right decisions. So when they start investing, they've got the right knowledge. And I think about if you look at Harbour Wealth, we've got specific licenses in place that actually allows our clients from an independent point of view to be able to make informed decisions as well as they are not limited. So the wider you throw open the field of investing and doing planning for clients, just the more broad the decisions is that they can make. So yeah, you said there, my passion is helping others so that they don't make the wrong choices, looking at the past, and if they get to the age of 50 or 60, then all of a sudden it might be too late. But like I said on some of my social media posts as well, is it's sometimes never too late, because yes, this is your early stage to financial planning, but some people are early in their 40s, early in their 60s, or early in their retirement. So yeah, thanks. I'm looking forward to today.
Thanks so much, Wilco. I mean, from our side, it's a pleasure. You know, what Grovest really stands for is we try to be pioneers in the financial services industry. We want these conversations to happen, and we want them to happen with people like yourselves who can really help just the greater good, you know, and I think that's really what today's about. And maybe if you don't mind, just briefly touch on what you meant by the fact that your licenses are broader. So does that mean your investors aren't necessarily limited to a specific range of products, or how does it work? What exactly were you alluding to there?
Okay, so basically within the financial services provider industry, if you're a financial services provider, you've got specific categories that you're allowed to give advice on, or specific products that's available in the market that you can give advice on to clients. Now, how I normally put it into medical terms is you get a GP, and then a GP might have all the knowledge, and he can give you all the advice, and he can give his opinion, and he can steer you in a direction, but he's not allowed to operate on your heart because he's not a cardiologist. So the way when you deal with Harbour Wealth is with the licenses, a Cat 2 license, having our own model solutions from an independent point of view, you can deal with the GP as well as the cardiologist, and you're not limited to a specific field of planning.
Awesome, thank you. I love the metaphor. I'm just going to briefly maybe introduce myself, my company, what we do, where we're from. So I'm the fund manager of Sunstone Capital. Sunstone Capital is part of the Grovest group. Without going too much into detail and making this a little bit more confusing, Grovest were the first Section 12J company that existed, which means we've got the license and the ability, and we work with SARS to offer tax-deductible investments. We've been fortunate to work quite closely in my particular fund, Sunstone Capital, for the last 2 years with EasyEquities, and over the last year with Wilco, and it's been great and wonderful. And what we really stand for is what everyone around this table stands for, is trying to create a better financial future for South Africa, and just allowing opportunities to people where they've never had access to such opportunities before. So that's enough about me, I guess. Maybe we can move on to some Stans, or Paul rather. Do you want to put up maybe Standwa's first slide, and we can just have our first conversation now. Our first topic is actually just going to be around investment trends. So EasyEquity is probably, I would guess, to be the largest stockholding platform in the country with over 500,000 investors. So what that means is they also have really useful insight and information as to what people are doing. And I think part of that disruption has been, you know, they really focus on making investments easy. And as a result, a lot of young professionals who otherwise would have been nervous to get into the realm of stock picking have been using this platform. So Standwa has prepared an awesome slide for us, which maybe we can spotlight, and he can just talk to some of the trends and the things that's going on. It's a roundtable discussion. So Wilco, please feel free to chip in or add some thoughts as we go along. Paul, I don't know if you can spotlight that slide, please.
So I'm going to start with, I'm going to circle back to the investment trends that we've found at EasyEquities. But I'm going to start more with finding the balance between wealth protection and wealth creation. And EasyEquities plays more on the wealth creation kind of side of things, but wealth protection is a very important part of your financial journey as a young professional. And so how I would say, you know, this starts is by understanding your hierarchy of needs. And establishing a kind of wealth protection is actually very important in your financial journey. So I would say understand the different facilities that are out there in protecting your wealth, because now you're making an income and you wouldn't want to necessarily lose it, or should you lose it, then you'd be stuck in a rut. So I look at it as, firstly, personally, I would say I look at my needs and ensuring my security is in place. So that's the more rigid side of financial planning. And that is making sure you've got life cover, income protection, which actually Wilco spoke about at a event we had in Pretoria. And I actually ended up taking up income protection after that chat. So I wanted to surprise you with that.
Well done, well done.
Surprise you with that. So and that sort of thing. And that's sort of the more rigid side of financial planning. Now, for me, where the fun is in the wealth creation, and that's where sort of EasyEquities plays. And in that, that's where you get more creative and more flexible. But within that flexibility, I would say once you've found a strategy that works for you and where you see yourself wanting to go, stick to that strategy because it's a long-term game. And so once you find your strategy, stick to it. And so in my hierarchy, I would put the necessities at the base and then the wealth creation as the next step. This is me personally. And then something that a lot of young professionals in South Africa will have to deal with is cultural obligations. And that speaks to sort of familial obligations, black tax, and lobola, things a lot of people have to deal with. And I would say that is something that is not necessarily, well, it goes from family to family and person to person. None of financial planning is a one size fits all kind of thing. And having this as your next step in financial planning is something that I would say is it's more in tune with what your relationships are and what your obligations are. And then finally, the fun stuff and entertainment. I'm not saying you have to budget for the fun stuff. Personally, I haven't done so in years, but now I found that I have to budget for December because it's kicked my butt every time it's rolled around. So I've made sure now to actually to make sure that I'm okay in December. And part of this whole financial planning, this financial journey you're going to go on as a young professional is you need an assistant. And to me, this assistant comes in the form of technology. I can't afford an assistant, so tech is my best friend. And in doing so, I would say tech is meant to help you. So look at your banking apps. If they're the more savvy, the better. And if the more savvy, the better for you as a young professional. I would like to see where my money is going and exactly how much money I'm earning. And the better the banking app, the more savvy it is, the better for me. And also budgeting apps. I know a lot of my peers' favorite is 22/7. I also used to use 22/7. I need to jump back on that horse. And it's great in helping you navigate your own finances and seeing exactly what's going where and categorizing them so that you can actually prioritize according to your needs. And then there's also making sure that search engines, the internet is your best friend. Because if you're going to find deals in securing your wealth and protecting your wealth, make sure that you've vetted everything and you've found the best deal for you. And the internet is the best place. Search engines are your best friend. And then finally, I would say investment apps, and this is where EasyEquities comes in, but I'm going to try not to be biased right now. I would say, as a young professional, finding an app, and millennials are like this. We like transparency and we like convenience. And so find something that speaks to your personality. Find a platform or an investment channel that speaks to you the most. And the more convenient, the more transparent, the more accessible, I personally find the better. I wouldn't want to sign up for something I don't understand. So do your research, and all these things require research from the income protection and the wealth protection to the wealth creation that comes with it actually investing. Requires research. So if you're thinking of just sitting back and not necessarily thinking about it, I don't think that's the best route to go, especially since it's your money. It's not really anyone else's. And now something that one of my colleagues mentioned to me, it was, as a person, when you're going on your financial journey, it's great to understand your relationship and your history with money. And so understand how your psyche and your psychology, your relationship with money psychologically. For instance, looking at how you spent money historically, from your younger days, probably. Are you more of a risk taker or are you risk averse? Are you a penny counter, or do you leave stuff in the bank and not think about it? And there's no right or wrong to this. It's all about striking a balance and speaking to your personality and your psyche. Do you see money as fun, or do you see it as serious business? And are you emotional about money, or are you cold about it? And consider all of these things. Consider writing them down and journeying yourself, because that's part of growth as a person, but also understanding your relationship with money. Personally, what helps me is actually writing things down so I can see how I've grown and form habits from that. And how do you attain goals? Are you someone who would like to swing and hit big and then, rest? Or are you someone who works at small daily habits to achieve your goals? And a lot of these things, shape the way will shape your financial security, will shape your wealth creation and wealth protection in the long term. So establish that, understand yourself, and that's pretty much what the journey I'm on as well. Because like it or not, money is a massive part of how we view ourselves. And yeah.
Awesome. Thanks, Stanza. I mean, that's really insightful. I've got tons of questions. Maybe I'll hold some of mine for the Q&A at the end.
Sure.
I think what's interesting is that, like, what really stuck out to me there is that everyone's financial journey is different, and it probably changes with time. And it's not just internally. There's external changes. There's changes in the economy. There's macroeconomic changes that happen. For instance, like I'll be blunt. I've always played on the stock market, but I haven't been very focused on it. I'm certainly not very good at it. Right? That's for sure. But what happens is lockdown came, coronavirus hit, and I had a little bit more time on my hands. Why? Because I wasn't driving to work. So I thought, you know what, let me get a little bit more aggressive. Let me start reading up. And what I found is exactly what you're speaking to, is that there's some really amazing information out there. Just by following, you can maybe follow Wilco or Harbour Wealth. There's all these insights that are out there on the internet. Just by following EasyEquities, or Simon Brown, there's so much to learn. And all of a sudden, I'm seeing what's happening in the stock market. Oh, hold on. Wait a minute. They think that we're going to open up, leisure travel. What happens to the gaming groups? And there's been some really interesting spikes and traps over the last couple of months. And I thought maybe you could share some interesting information just around like which shares have been picked, what's happened to the easy equity base over time. Has COVID shifted that? Has the type of investments been made, the quantum, the number of people? What's been happening on the behind the scenes? Because I just see those numbers go up and down. I'd love to know what's happening behind all that.
So COVID's been very funny because what ended up happening is exactly what you're saying. You had more time. People had more time to chill and have a look at the finances and look into investing. And what we saw was a spike in our registrations from March until, to date. We hadn't seen spikes like that in quite a while. And so what ended up happening is this year, we've, I think, more than doubled our client base from the previous year. And you can sort of track it as it being since COVID, since literally the month of lockdown, our registration spiked. And so that's what's happening. People are now investing and taking more stock in the stock markets and their investments in general. And so what's ended up happening is, fine, people are doing research, but we're also seeing that people are still following what the rest of the herd sort of does. And you can see it in the most bought shares that I've highlighted in the graph there, or in the slide there. In 2020, Sasol was the most bought share on our platform, and it outdid the second place, which was MTN, 13 times over. Sure. And it's for me, it's clear that people are just going on the trend of seeing the news of Sasol, hearing people talk about the opportunity of buying Sasol, and then deciding to invest in it. Not to say though people weren't invested in Sasol beforehand. No, people were. But I think people recognized the opportunity and got all their friends and everyone they know and into a stock like Sasol.
If I can quickly come in there, Stans. The funny thing is I've had so many. So since lockdown, you're at home, you're working, you've got your video sessions every single day. And so my son is in the background, he's listening to what's coming in, and there's phone calls, and specifically on when Sasol fell to the ground, basically. So every single client would phone me, should I buy? Should I buy? And then I say to him, well, have you done your research? So I'm going to come in with that as well. But because sometimes it's not good to catch a falling piano. But it's funny that you said that Sasol, because long story short, my 9-year-old is currently invested in Sasol shares because he just decided, you know what, from what he's hearing, he needs to be in on it. And he took his pocket money and he bought Sasol shares.
I love that. And I'm thinking, I'm wondering if people like your son just put everything, all his pocket money into Sasol, and you just, because that's kind of a gamble to put everything into one thing. I think diversification is something a lot of investors, including, but your 9-year-old has a long time. Like he will learn this lesson probably somewhere down the line that actually maybe not all my eggs should have been in this basket.
Yeah.
So we're seeing.
Hopefully, I can guide him. Hopefully, I can guide him the right way.
Listen, if you guided him the way you guided me, I think he's gonna be all good.
Okay. Can I ask you your thoughts on something? I mean, while we're on the topic, I mean, for all my sins, and maybe I'm only comfortable sharing this in the last couple of days, but for the last 2 months, I've been looking at Investec stock price, and I've been saying, you know what, this isn't right? Because I don't know if you remember, they did a split from, I think it was 361 or whatever. They split off one of their asset management groups. Stock price dropped like 40%. I thought I did my little bit of Twitter research, right? And I thought, listen, it's a bit overpriced. It's a bit underpriced at the moment. And I was saying, buy. And everyone who bought, and I'm now chatting to my friends, and everyone's saying, what stocks? And I'm like, listen, guys, I made a great call on Telkom. I sold it. So now I'm looking at Investec. And for the last 2 months, I've been carrying my head in shame because everyone I told to do that is now in like an absolutely awful position where they're like down 5 or 10%, and like the rest of the market's sparking and booming. And over the last couple of days, we've had a recovery. So last night I got a WhatsApp from one of my friends. It was about just after close of business, about 6 o'clock. He said, by the way, thanks for Investec, right? And I was thinking to myself, like, first of all, thank God he held, because if he sold at a loss, I would have felt very awful. But it's almost like there's this balance between, herding, where we all want to kind of do things together, but there's also like a bit of a danger there, right? I'm not a financial advisor. I shouldn't be. Maybe I can be sharing with my friends, but for my friends to be going off my recommendations is dangerous, and I don't even know their financial situation. So for me to comment is more risky. What are your thoughts on social herding? Do you think it's good because it creates awareness around people investing in stocks, and just the fact that EasyEquities were able to double the number of investors means twice the number of people are aware of what's happening? Or how do you see that risk-reward balance weighed out from a financial advisor, from a wealth managing perspective, rather?
Yeah, obviously. So there's basically a lot of answers to that, and I think the key is, like Standwa said, is you need to be diversified, but you need to go in with a plan. You need to go in with a goal. Back to my son, I sat down with him and I said to him, I'm more than happy to take your pocket money and buy on EasyEquities platform. We bought the shares. But I said to him, we've got a 5-year plan, because that gives him enough time, because then he's 13, 14, to read up, study, make actually sure that when he hits high school, he can cash it out, because that's our 5-year plan. If you go into anything, and that's what people must watch out for. I have a slide, and afterwards, people will be able to download my whole presentation. Today, we're going to focus on just the 6 points. But the one slide that we love, and just emphasize, Harbour Wealth are not stock pickers. We're there to manage your wealth. We're never, ever going to pick stocks for you. We come in from a cost, tax, structuring perspective, and we look at your whole portfolio to see that, okay, can we win in certain, let's call it stocks? That's why EasyEquities is there. I love actually telling my clients, you know what, take a portion of your money and go and learn, because the more you learn, the better conversations I'm going to be able to have with them. To give you an interesting stat, now this is from 95 to 2017. If you look at the market and you try to just pick stocks every now and then, but if you stayed invested, you would have had an annual return of 15.57%. So let's say you went into the JSE stock market, and you bought the index. You would have had a 37%. If you missed the 100 best days, just the 100 best days. Now you can go and try and calculate how many trading days was in that 22-year period. You would have been down 3% on average. So that's how scary it is. And to come to your question, I hate it when people phone me in black swan events like COVID has given us, the Sasol falling to the ground. There's lots of opportunity that's happened. But I mean, that's why we call it black swan events. They don't come up every day. So it's very critical to make sure that, okay, if I'm going to take a few bucks and buy a falling piano, I can actually afford to lose all of that. If I didn't sit with someone and had a conversation with them of where am I going with this and what is my plan? Because Standwa also said, planning is important. You can't just run into something thinking that it's gonna happen for you. 100. I hope that answers your question.
Awesome. No, that more than answers it. You take a couple of minutes to think about that. But maybe just before we hop on to Wilco's session, I'm going to do one question, if you don't mind, from the questions that were answered. And I think Standwa and Wilco, I'd love both your insights on this, if possible. The question was asked by Michelle. She said, when buying shares, what does one really need to check? I saw an option of a DCX, and that's the crypto, if I'm not mistaken. Standwa, you can talk more to what DCX, but I think it's some kind of crypto tracker on the EasyEquities platform. And the question is, so two parts. One is, what do I need to check? And what does it mean when I'm owning shares as part of this tracker or as part of this DCX? Can you maybe just talk to that? And maybe you answer that side, and Wilco, you answer what one really needs to check. How does that sound?
Fantastic. So with an index like DCX, what actually happens is it's like an ETF, which is another investment vehicle where you buy a bunch of shares that are consolidated into one themed product. So the theme of DCX is cryptocurrencies, and it's the top 10 cryptocurrencies in the world. And so what ends up happening is when you buy a share in DCX, you're actually buying multiple different cryptocurrencies in that little package that you've got. So it's like a little neatly wrapped package, and you're buying exposure to different cryptocurrencies, but in essence, you're buying crypto as a whole, pretty much the biggest representatives of cryptocurrencies. So that's pretty much what happens when you're buying into DCX or EC10 now. It's going to be called EC10.
That's awesome. And just to be clear, you do own shares, right? It's just a tracker. So you're still owning shares. Maybe just to answer Michelle's question, you're owning shares in all these underlying cryptocurrencies. You're just bundling them and packaging them for diversification and other reasons.
That's correct. Yeah.
Okay, cool. Wilco,
right,
tell us.
So on the, what do I have to look out for? I mean, there's so many things. Once again, is it when you're going into it, what is the plan? I'm always going to go back to that, Avi. I'm always going to say, what is the plan? And then, have you done your research? Are you buying into, like I can would stand with a group of cryptos that are they well priced? One thing that I wanted to say earlier, and I laughed at Facebook with all the Ponzi schemes that also popped up over lockdown. And I always say to everyone, the moment social media starts talking about something, then you might be too late. So, I mean, I see Bitcoin is running. It's running extremely hard the last few months. And all of a sudden, people think that maybe we need to jump on the bandwagon, but have you maybe not missed the boat? So there's so much research, but I think it's important for Michelle to sit down and say, okay, I like this. I've done my research. Is it at a good price? And then what is my goal? What am I going to achieve? And then also maybe sometimes it's good to look at the tax implications on an investment that you're going into. So that also needs to be in line with your future goal of this specific investment.
Sorry, Avi, actually, I would like to answer another question that I see in our Q&A box here, and it just speaks to the investment trends, and then I'm done. So it's a question from Gosinai Team, and they're asking about the gap in gender distribution and what are our thoughts on that? And so I'd like to just refer back to, I think it's the gap is closing in gender distribution when it comes to investing. And so a study or a note released by Lightstone and also picked up by News 24 was that single Black women, I think over the last year, have become the biggest buyers in property. And we've also seen that in EasyEquities, where the gap between male investors and female investors has closed. So back in 2016, when EasyEquities launched, we had 16.99% split to 83.01. And now it's closed to 39%, that's women, 39.2 to 60.81. So the gap is closing, and there's a lot to be done in order for us to make sure it's completely closed. And yeah, so that's my thoughts on it. I don't know if Wilco or Avi has thoughts on it. I'm done on the trends now.
Yeah, I think that's great. I mean, I think it's incredible. I also know you've run some really interesting campaigns, promoting women investment that I've seen over Twitter, and I think it's meaningful, and I think it's exciting, and I think it's part of the way of the future. So kudos to you guys for what you're doing, and kudos to the ladies for joining on the investment train. I think it's really amazing. Maybe let's just move on to the second bit. if that's okay. Wilco, if we can maybe pick up on your topic. Wilco is going to be talking about financial habits. Just so everyone knows, we had one or two prep sessions around this webinar just to make sure we're prepared. And Wilco started talking, and I almost stopped wanting to talk myself. So I'm very excited for this portion as well. And I think there's going to be some really exciting insights. So Wilco, maybe you can just kick off and tell us your thoughts here.
Right, brilliant, Avi. So, guys, you will hear that we've touched on so many things. And to invest, I always say to clients that don't overthink it. Once again, I'm a picture person, so I go into my little stories and I love putting it into practical terms. And I say, when you go and visit the doctor, you're going to tell him your symptoms and you're going to say, I've got a runny nose, this and that, headache. And he's got the knowledge to actually tell you, you know what, this is what's wrong with you. There's your prescription, and go and have fun. Now, and that's how 99% of us are going to operate. So when it comes to investments, specifically when you do it yourself, it's important to have all the knowledge available. But that's why you do get wealth managers that can actually assist you. And that's the same when a client sits with me. I say to him, sometimes don't try and overthink it. Give me your symptoms and I'll give you the solution so that we can fix what your investment problem is, if I can call it that. Back to the GP, he's not going to explain to you where the bacteria started and how the bacteria grew and how that affected this part and that part and going into your lungs and affecting this and throwing a lot of medical jargon that you don't understand. No, you want your prescription and 3 days later you want to be better. And I think that's the same with investments. Have a plan, tell your wealth manager where you want to go with this, and then stick to that plan. I think that's very important. All right. So the financial habits, and I could have changed this heading as well as, what are the mistakes most older people make? Or what did some people not stick to? Now, we are creatures of habit. So that's why I thought it would be good to have certain habits in place so that you can keep yourself to eventually, I'd love it to say, where you win. Okay. So the first one is knowing where your money is going. And that's where budgeting comes in. And there's a lot of apps out there to help you. Standwa mentioned 22/7. And I mean, I've also downloaded, used it a couple of times. But a budget is never to take the fun out of living. A budget should not be seen as, now I can't have fun anymore. A budget is just there for you to actually know where your money is going and what you're spending it on. And at the end of the day, you actually want to plan how to allocate those funds in better ways. So that's what I want to focus on when it comes to budgeting. Don't think it's taking the fun away. It's just knowing where your money is going. Then the second point is appropriately investing for the future. Now, I love putting it in two different sectors where I say there's saving and then there's investing. Now, saving is basically, it's just money not spent. So we save up that's your short-term money. Back to when we set up goals for clients and we talk about the investments, we always put it on a timeline to say that, okay, what is your short-term goal? Your 1 to 3 year type of money. And then your 3 to 6 and 6 and longer, because that can actually assist me to guide you in the type of diversification you need in all the different asset classes. Should you be in growth funds? Should you maybe be a little bit more conservative? I mean, imagine someone approached you and said to you, you know what, I only want to invest for 6 months. And then you put all his money in a growth fund, and his 6 months was at the end of April, he needed the money, and all of a sudden the market crashed due to COVID. He's going to be furious at you. But if you knew from the start that, listen, this is a 6 month or a 12 month, you would have gone, we call it applying science to investing, because it's actually not difficult. You just apply the science and you'll be okay. And most of the time you'll be in a winning situation. Right. So saving for the future is good. Yes, Avi.
Sorry to stop you there. I wanted to ask before we go any further, because I have a question there. So it's all, I understand the value of planning, and it's hugely rewarding, but and I'm going to throw probably a difficult question at you, and I'm sorry to do it 4 minutes into your thing, but
just mute myself and think about it and then come back.
What if the situation changes, right? And I think what's interesting is, we're gearing these talks around, Grovest, especially around young professionals. And the thing being a young professional is, there's a lot of oscillation. One day you're earning X. Next day, you can be promoted substantially. You can finish your articles, you can qualify, you can get a promotion, and vice versa. It's a very tough job market out there for young professionals. So you can also find yourself in a position where, pre-COVID or ignoring COVID, just in general, where your financial situation changes for the better or the worse. And I guess the question is, how often should one review their financial plan, and be like, how do you manage these changes? And what are some really important things? Because we're talking about planning for the future. So how do you do that when your present is challenged or your present changes? And I'm sorry for the hard question.
No. It's not. It's one that comes up every time, because dealing with young professionals, like you just said, I think the important thing is having real discussions with your wealth manager, with your accountability partner, not just being sold something. Because the problem that I see is, and back to what Standwa said in the beginning, there's no one size fits all. And it's very important to be able to be invested on a pure investment platform. Because what are some of the challenges that's out there? People, they pair up with, let's call it, an agent of a specific company. The agent can only sell them certain things to make a certain fee or commission out of it. So at the end of the day, is the client really the center of the discussion that we're having? Or are we steering towards a product that we can sell them where the most commission lies in? And that's why we've steered away as well. We call ourselves wealth managers, because back in the day, it was a broker, and a broker was just there to sell you something. And then it changed to a financial advisor, and the industry went to a whole selling. It just changed the name. Where Harbour focuses on, we're wealth managers. I manage your wealth. We're not there to sell you anything. So if the situation changes, at least we know we're on a pure investment platform. We've actually got access to our funds, and there's no penalties or anything involved. If you need the money, we sit down. Back to the review question, I'd say, if you're serious about investing and thinking about your future, maybe sitting down with a wealth manager once a year is good, but you need to evaluate it at least every quarter to see that, okay, is there maybe certain things that changed in my life personally, so that I can maybe phone Wilco and say, listen, my situation is changing drastically. The chances are good that X, Y, and Z. The one thing that I get a lot is, Wilco, I'm going abroad. So we started investing in South Africa. We're all in rands. I'm going abroad. This is a 12 to 18 month process. How can we start structuring my portfolio so that when I do make that move, things are in place?
Okay. First of all, okay, always your answers give me more questions. So I'm going to not hold off. Maybe point out something that I think is an interesting point that I'm taking from this is just using your doctor analogy. It doesn't help to get sick and then try and find a doctor. You actually need your regular GP who knows who you are. So, you do your annual checkups and he says, Avi, you're doing great, or you're doing awful, lay off the pizza, whatever the case may be. But when your situation changes, you can call and say, listen, doc, I'm not feeling so great. And it's not a question of who are you, what's your background, trying to get your history. So I think that the lesson, one thing I'm taking is you need a Wilco, right? You need a wealth manager. You need someone who knows where you are before you're in trouble. Because to turn around and say, well, I was here and now I'm going there and I don't know where I am. If you don't have a plan, and if you don't have someone who understands that, who's objective, who's a third party, you're probably going to end up in trouble. Okay, cool.
And that's where I can actually jump to point number 6, having an accountability partner. So once again, back to my little stories. I say, if you can appoint, let's say everyone in South Africa could appoint their own personal shopper today. Now, and that's the only way you're allowed to shop going forward. We're not allowed out of our houses. You've got your personal shopper, you pay him a fee, and he's going to go and get whatever you want out there. But now we've got 10 shoppers standing in front of you, and they need to pitch to you. Now, let's say the one guy's from Woolies. Woolies can give you a lot. So he's maybe got a partnership with Woolies, and he's got a partnership with BMW. That's his license. So back to the GP part. So now you sit with him and you think, okay, maybe I should partner with this guy because Woolies can give me clothes, they can give me food. And when I need a car, yes, brilliant, I've got BMW. So without thinking, making a haste decision, and yes, he sounds very convincing, I sign up with this guy. And then all of a sudden, you realize, but oh boy, I actually don't like BMW. Now, I can't get myself another car because my personal shopper can only get me BMW. And that's back to the wealth management, the accountability partner. Who do you partner up with right in the beginning? Do they have the right licenses? Are they independent? It's important because you don't want to sit with another need in your life, but now the guy that you've partnered with for the last 10, 15, 20 years actually can't satisfy that need. Now you need to phone a new person and go and explain your whole background, and it's just a mess. So that's why it's important right up front, who do you partner with? And I mean, also getting part of groups, who's making decisions. So yeah, I just wanted to quickly touch on the point 6 then there. If we run back to the savings, why do we want to invest? We actually want to outperform inflation. So if you take the rule of 72, and people can go and Google it, there's actually calculators on the rule of 72. But if inflation stays 6%, then your money is actually going to half within the next 12 years. So the scary thing there is also in my presentation, I've got little pictures, and I say, back in the day with 1,000 Rand, you could actually buy a VW Beetle. So a Volkswagen Beetle, you could buy that for 1,000 Rand. And then a few years later, you can buy a bicycle for 1,000 Rand. And nowadays you can buy a pair of Nike Takis. All of them are actually forms of transport, but it literally went from a car to shoes in a matter of years. So that's why we need to invest so that we can actually outperform inflation and your money keeps on growing. Okay. Then quickly going to when we start investing, there's a lot of investment jargon out there that we might not understand. I have spoken about this. Partner up with someone, get yourself a platform that can cater to all your needs and actually explain it to you in simple terms so that you can work towards your goal and your plan. Long-term planning is key. There's different tax and cost implications. Please, if I can say to everyone out there, before you go into any investment with anyone, remember these words: effective annual cost. It's important to ask what the effective annual cost is on the investment that you're going into. I've seen some horrendous figures out there in the industry where people really just want to say they go back to, Paul, just go back to the main slide there, the front one. You don't have to skip. Yeah, just leave it there. It's fine. Where the costs are really so bad that the only people that are winning is the company that sold it to you and the advisor. And we've done a little calculation. If a company can save you just 2%, and you'll be surprised to see that a lot of effective annual costs are above 3, 4, 5% per annum. If we can save you 2% per annum over a period of 20 years, we're saving you 43.86% on your total fund value. Now, the scary thing is that's half of your money gone, not because anyone did something stupid or you were wrongly invested. That's purely because of fees. So please, effective annual cost, focus on that. All right. Then protecting yourself and assets. Standwa spoke about that right in the beginning. And yes, that's also actually supposed to be my first line. If you think about it, I don't care how much you've got. What stays your biggest asset? It's your ability to be able to earn an income. It's your ability to make decisions in this life. So you need to speak to someone so that you've got the right things in place that's protecting your assets. And that does not necessarily only allude to life cover, disability protection, income protection, critical illness, and all those. How am I actually protecting my wealth so that maybe one day when I die, are my things correctly structured so that I don't lose 20% due to estate duty? Citus tax, probate tax, that's things that we will discuss maybe in part 2. If you've got physical assets in the UK or in the US, you can be knocked to 40% of your asset value before it's brought back to South Africa. So it's small little things like that where you can actually protect yourself and your assets for generations to come. And I think the key there is it's important for you when you plan to have the mindset of creating wealth over generations, because I think that's the biggest gift coming from a father with 3 kids. I can't wait to set them up and make life easier for them, because why do you want them to struggle on their own and try and survive it? So that's just quickly on that note. Then ask questions. People just go blindly into stuff. Back to the educate yourself. There's a book that I love of Tony Robbins is called Money, Master the Game. It's an extremely thick book. You need the whole of COVID lockdown to work through it. But do yourself a favor, go and buy that book. Work through it this December. You're just going to have a completely different mindset of how you're approaching your own finances. And you'll actually realize that to retire, you don't need hundreds of millions. He simplifies it very nicely. So that's one of the things, but also ask questions. Just carry on asking questions. Yes, Standwa.
Speaking of questions, I've got one, and also I see one of the attendees has. What would you say, like in your opinion, is sort of like an acceptable EAC, like a guide based on what? How do you determine for you as an individual?
Well, it depends on what your asset allocation is. Your growth, more riskier funds or stocks are more expensive. So it depends on which platform you're using. But from a Harbour Wealth point of view, I don't want any of my clients to settle for anything above 2%. If your effective annual cost is above 2%, you're paying too much. So anything below 2%, that's where you want to aim at. Nothing above that, because I can promise you, Harbour Wealth will show you, we've got all our model solutions. Some of our blended active ones are a little bit over, but the majority are below 2%. So that's what I would say. Your average is 2%.
Got it.
Okay, brilliant. I want to rush and run through it because I think that we're going to have a lot of questions. So the fifth point is just saying no. Millennials, fear of missing out, FOMO. That's something that I had to learn, and now we're moving on. I've heard the other day there's now for the centennials, there's a fear of being irrelevant. So that's a new one coming. There's actually a fear of not being relevant. So that's the new thing coming out. But don't have FOMO, people. You'll see in my pictures, you don't have to, at a young age, drink the most expensive champagne, live in the most luxurious apartments, and just have holidays overseas. You can actually still have a very nice cup classique when you want to. You can stay in a normal apartment, and there's a lot of beautiful places in South Africa that you can also still visit that will eventually one day benefit you. Don't let Instagram and social media posts rob you from future wealth. And then I've touched on the accountability partner. So Avi, I think, yes, there's, one little story before I finish. So one of the things, and Eugene loves making use of this example, one of our directors at Harbour, is if you're going to go into a partnership, and who are you going to choose? Now, Avi, I'm going to put you on the spot there because I'm assuming everyone knows who Usain Bolt is. Now, let's say the Olympics carried on this year. Would you have put money on Usain Bolt to win the 100 meters?
Yeah, I would have.
Are you 100% sure, Avi? Think about it.
No.
Why wouldn't you? I just had to put you on the spot there. Why wouldn't you put money on Usain Bolt?
I mean, I guess I'm not the biggest expert on world runners, so I don't really know who's.
There we go. Okay, brilliant. So if you've done your research, and I didn't put you blatantly on the spot, so sorry for that. But he's retired. He's done. He's not running anymore. So that's why when you go into an investment, not mentioning names at all, but do your research to maybe go and see that Usain Bolt was the greatest living athlete ever. I think it's going to be tough to beat a guy like that. But you're not going to put money on him anymore because he's retired. And that's what I want to leave everyone out there with, is just with that thought is, when you partner, when you go into something, have you made sure that maybe they're not retired yet?
Thank you, Wilco. I know we got a couple of minutes left for some of the Q&A stuff. So what I want to do is I'm just going to pick some at random. Everyone, thank you for your questions. If they aren't answered in the next couple of minutes, we will respond. We're going to also send out a copy of this webinar. It'll be, I think, also available on the Grovest website, and you'll have some of the responses as well in writing. There's also, just so you know, a very nice presentation that Wilco prepared, which we obviously didn't have the time to run through the full thing today. and we will be sharing that with you as well. So it should be a nice way to get started and maybe offer some more depth and insight that Wilco clearly has and that he's been so kind as to share with us today. So the way I'm going to do this is I'm going to pick questions at complete random. Wilco, Standwa, pick up your hand, whoever wants to answer it, and I'm just going to go for it. I think the first one here is probably going to go to Wilco, to be honest, is how much money would you have to have available to benefit from hiring a wealth manager such that the cost of hiring a manager doesn't outweigh the money you can make? So Lisa's basically asking, you know, is a wealth manager expensive? Is it going to cost me more than I'm going to save or make? So that's her question. Maybe you can.
All right. So just quickly to touch on that is, as a wealth manager, I charge an advice fee. So once again, it depends on who you're partnering with. The ballpark figure with us is 0.5% per annum. So the good thing is, when you bring me 500 Rand, it's important to go and say, and that's why I want to allude to, 500 Rand can actually get you investment exposure to very nice asset classes and growth funds available out there. So you're going to be charged at 0.5%. Our industry is moving, and we've got the capabilities and things in place to be able to invoice you. But for now, it's about, I think answering the question is, you're going to be charged a fee on your fund value, and you will get a lot of value out of that. And you have to go and see who charges you the less or the least out of everyone out there when you go and maybe do your research on who you're going to partner with. But I think to answer the question is, you don't need a lot of money, because if you're on a pure investment platform, 500 Rand or 1,000 Rand a month is going to give you exactly the same exposure for exactly the same fee as anyone else. And remember, a 0.5% stays 0.5%, whether you've got 1,000 Rand or 1,000,000 Rand. And I think that's what people also need to think about, because when you've got 100 million, 0.5% seems like a lot of money that you're paying, but it stays 0.5. And that's the same with a 500 or 1,000. Lisa, I hope that answers your question.
I think that was great. I'm sure it did. Maybe just an interesting point, and maybe it'll touch a bit on the trends as well, is Julius asked, what's the best mentality when it comes to buying and investing shares? Obviously, everyone wants return and they want to enjoy their investments at some point. And I think what might be a good time to bring up, you know, our next session that we're going to be having is going to be on impact investment. So we're going to talk about, you know, there is an emotional side to investing. There's obviously, there's a financial decision element, but there's a certain part of it that needs to come from who you are and what you value. And Julius, when you're talking about returns and enjoyment, I think that's just an interesting thing to talk about. I think, you know, Standwa, maybe you can share some thoughts on how you made investment fun and how you keep these investments, you're able to enjoy them over time, both from a financial point of view, but also from a process point of view. You know, what is the mentality that one should have? What are your thoughts?
So I think the best mentality to have is curiosity. Be curious about what you're about to invest in. Be curious about yourself and how much risk you're willing to take. And just sort of mix the two and just be curious and want to, you know more, research, you know, speak to people around you. And, you know, an openness, I would say, is also a nice way of navigating through the stock market. So in terms of mentality, I'd say curiosity is kind of the best mentality to have.
Awesome. I think that's a cool answer. Wilco, another quick one for you, and then I think we'll do one more question after this. I'm going to combine two people's questions in one. So we basically had a number of queries from Bosisani as well as from Xander, right? The question is, what percentage of money, i.e., is there a reliable method, a rule of thumb almost, because Bosisani talked about a 4% to calculate the amount of money that you need to retire, and Xander was talking how much percentage of your available monthly income or monthly savings should you invest in the stock market. So are there some kind of broad rules, Wilco, that everyone can say, like, you know what, I shouldn't do more than 10% in a high risk and 4% is good for retirement? Or does it depend on other things? What are your thoughts?
Okay, so I think if you go and Google it, you'll see that most people say if you want to retire comfortably one day, it's going to be a 15 to 20% of your income per month needs to be put away for long-term investing. And I think in the times that we are in, most people will agree, but that's extremely tough. So coming back to having continuous evaluation of where I am, where am I going with this? I always say to clients, I don't like using a specific retirement age. I call it, we're working towards retirement. Because when you draw up an Excel spreadsheet, when you put things out there, you tend to get either scared or happy, and you try and track yourself, and it's good to track yourself of where you are going. But continuously evaluating, some people are retiring at 40, some retiring at 50, some at 70, some never. And it depends on how we've worked towards that. So the percentage of how much we must put away is going to be purely a discussion between you and your wealth manager. And then just quickly, lastly, how much percentage do I need to be allocated towards stocks or retirement or this or that? I think it's important that when you enter into a model solution like we've got at Harbour, is we go and evaluate where's opportunity or how the economy is reacting at this moment, where can we see growth. But your 4 asset classes, equities, property, bonds, and cash, and always make sure that you diversify through all of those, because I see one of the questions there as well, maybe you're going to allude to it, is the property market down 40%? Should I cash out? Should I just cut my losses and get it over and done with? That's why it's important to be diversified, so that if a specific asset class falls to the ground, then your whole portfolio is not impacted to such an extent where, should I cut my losses? Where you can actually say, you know what, this will pick back up again, but have decent conversations. Look at the broader picture. COVID has taught us a lot. So yeah, that's just what I want to say with that. So there is a rule of thumb, but there's no right or wrong for anyone.
Brilliant stuff. Wilco, Standwa, thank you so much. Everyone, attendees, we've really appreciated having you here. This was part 1 of our series. Our second part is going to be on impact investments in Section 12J. It's going to be really exciting. 9 a.m. 1st of December. Please reserve your seat. Once again, if your questions weren't answered, don't worry. We are going to be sending out a copy of this webinar, a copy of the presentation, and some answered questions to you all. Thank you again for your time and have a wonderful day. Thank you, Stans. Thanks, Wilco. Thanks, Paul. And Grovest for putting this together and making these important conversations happen.